We are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the Week. I'm your host, Pablo Gonzalez, and with me as always is the man that I like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
Madison the Magnificent. Madison the Magnificent is in Mexico.
That's right. We are wishing her well. She's having fun out in Mexico, and we're going to hold the fort down for her.
We are holding the fort down. In the meantime, I'm going to be manning the chat as much as I can today. I got kind of spoiled having a magnificent community manager on board.
She's been a huge asset.
Yeah, agreed. But I've done this a time or two. So, go to jwbinventory.com if you want to download the property sheet right now. And if you are joining us on a podcast, we love our podcast listeners, love our YouTube watchers. My recommendation is if you want to feel a little bit more love, go to nyais.com.
Should be here right now.
Be here right now for what?
The roll call.
The roll call. You ready, GC?
Let's go.
All right. We got John Henning. Good afternoon, all. We got Bill Shields. Buenas tardes, damas y caballeros. We got Jen Filson, the fairy godmother of the Not Your Average Investor Show community, saying, hey, JWB family, greetings from Monterey, California. We got Bill Shields with an all righty then. Good to have you, Bill. We got Lee Bishop wishing everybody a great afternoon. He's the MVP of the Not Your Average Investor Show community. We got Leo Faraganan.
Dun, 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 dun.
Faraganan saying good morning,
dun, dun.
saying good morning all from Bay Area, California. Let's rock and roll. Leo, the drummer of a hair band, the famous drummer of a hair band.
Gosh, we have so many great personalities in this community. It's amazing.
We got Noah Randari, TBD on the nickname.
We need the nickname. Community.
I think TBD might be his nickname.
Oh, that's right. Okay. All right. I like what you did there.
TBD Noah Randari. Hello, everybody. Welcome. Noah, we got Ken Moline, the patriarch of the Not Your Average Investor Show, first family. I'm sure Carolyn, the matriarch of the family, is alongside with her. We hope to see Carolyn as well. We got Eddie Harris from Hotlanta. Hi to all, and Greg, Mr. IRR, Eddie from Hotlanta. I like that, Mr. IRR.
All right, I got that. That's me, my next tattoo.
That's really hard for me to pronounce, Mr. IRR. All right, we got Dean Curry checking in from Ohio. We got, Carolyn Moline, matriarch, is hanging out. We got Bob Wiesner hanging out with us here from Marietta. Good to have you back on, Bob, past star of the guest investor segment.
Absolutely.
And yeah, man, we got people rolling in. Since we don't have Madison, we got a slightly different segment, which is called GC Shares Good News.
All right, I get to share the great news today. Normally it's a little bit of a balance of good news and maybe some tough news that I get to share with you all today. It's awesome Jacksonville news. You don't even know this yet, I don't think.
I can't wait to find out.
Well, buckle up, buddy, because it's going to be some awesome news here.
There's no turning back, baby. This is going to be the all Ace Ventura quotes episode. There's no turning back, baby. All right, go.
Oh, man. So, one of the reasons that you invest in a growth market, one of the reasons why it grows more than other markets in the country and it has more economic stability is because of these anchor companies. And a great way to identify an anchor company for your region is how many companies make the Fortune 500. Jacksonville has long been home to 3 Fortune 500 companies. Can you name them?
Fidelity.
Fidelity what?
Yes. I know that there's like Fidelity National Services, and then there's Fidelity Bank or something like that.
It's not Fidelity Bank. Fidelity National Financial, and then Fidelity National Information Services.
Okay. And then FIS?
Well, that's FIS. I feel like this is Abbott and Costello here.
FI or freaking frack is what I've heard. FIS and CSX.
CSX. That's the easier one, right? There's FNF, Fidelity National Financial, FIS, which is Fidelity National Information Services, who we had Gary Norcross, who is the CEO of FIS. We had him as a past guest on the show, and CSX, all Fortune 500 companies. And those are the 500 companies in the country that have the highest revenues. Well, guess what?
What?
We got a 4th Fortune 500 company here in Jacksonville. Big shout out to Landstar, who just recently made the Fortune 500. incredible accomplishment. It's the first time they've been in the Fortune 500. They were in the Fortune 1000 before, and it's a trucking company. Has done incredibly well with logistics. As we know, Jacksonville is really a place where companies come to thrive, especially in logistics. Well, their revenue grew. They are now at 6.5 billion and provide a ton of economic impact and jobs here in Jacksonville. So we're super happy and proud, and proud for them to call Jacksonville home. They are the 4th Fortune 500 company, but the good news doesn't only stop there.
Don't let me stop you. Go on.
There's another company that we've talked a lot about and are hopefully in the process of having on our show, their CEO on our show at some point here in the near future, Dun & Bradstreet.
Dun & Bradstreet. All right.
Dun & Bradstreet made news last year for moving their corporate headquarters to Jacksonville.
That's right.
Because of a lot of reasons why companies move their corporate headquarters to Jacksonville. And they, for the first time, became a Fortune 1000 company.
Oh, wow. Okay.
Which is incredible. So they are a Fortune 1000 company. They have $2.1 billion in revenue, and they just moved their entire corporate headquarters to Jacksonville last year. This is wonderful news. Oh, and I wanted to add some other good news. So FIS, let's give them a shout out, right? FIS is mainly title insurance company. So largely, linked to real estate. Real estate's done incredibly well. Well, FIS jumped 50 spots on the Fortune 500 list to number 238. So everything is just moving really, really well for us as rental property investors, for us who hold assets around in the neighborhood surrounding downtown where these corporate headquarters are. This is great news. This is great. This is rent stability. This is rent increases over time. These are higher incomes coming to Jacksonville, which help rise prices for rents and prices for home prices, which is what we all are in search of over the long haul when we buy and hold this asset for a full market cycle. So incredible. There's not many other cities in the country that can say that they have 4 Fortune 500 companies. Again, more Fortune 1000 companies here as well. And a great win for all of us here in Jacksonville.
That's awesome, man.
Yeah.
That's congrats to Dun & Bradstreet. Congrats to what was the
Landstar.
To Landstar, big promotion, right?
Yeah.
Like that jump up into the Fortune 500 is no joke.
Amazing.
So Dun & Bradstreet got to, you said 2 point something billion.
2.1.
That's kind of like, that feels like a threshold to get into the Fortune 1000, like a 2 bill, something like that.
Yeah, 2 bills.
Do you know roughly what the Fortune 500 kind of like threshold is? Like how many billion that is? It's because it's revenue, right?
Yeah, it's probably right around 6 billion, because I think Landstar was like number 490 or something like that. So
yeah.
We got a little ways to go here at JWB to get there.
Landstar star is rising along with the city of Jacksonville. Love that. Median incomes, man. Like we talk about median incomes as the signal of how well the macro economy of a city is doing, right? And I come from a place where the median income did not rise alongside with cost of living, right? Like Miami, I know intimately that one of the innate problems that it has is this idea that cost of living in comparison to median income has the biggest disparity of major cities in the US, right? Like that's one of the big warning signs for Miami, which to me means it's money being invested from people that don't live there, right? Yeah. Like the economy is being built for people that don't live there. Whereas what I look at in Jacksonville that really feels like it's happening is, yes, property is going through the roof. Yes, cost of living is starting to rise as well, but all the signals that you see, I mean, I don't know if I can share this out loud, but like my wife has gotten like multiple promotions since she's been here.
Wonderful.
And her income level has risen in the, so that to me is like my canary in the coal mine is like, I'm an entrepreneur. So like my income rises based on other things, but like what, job promotions and economic prosperity of like wages going up in town, to me, from the way that I experience it, are going up, which means that this is a very sustainable rise of property values and whatnot, right?
The way I think about it is like, as a city, you want your population to grow, right? When your population grows, there's so many good things that can happen, right? Tax revenues and all this good stuff. So as a city, you want your population to grow. There are many cities that don't have population growth. So when you look at Miami, there's a lot of things to say that Miami is a success story, right? It clearly is, right? But if your population grows and it's not driven also by median incomes rising from your population, if it's largely outside money coming in, or if it's just expenses going up without incomes going up, then what happens is your city grows, your population grows, but the people that need to serve that city can't live downtown.
Yeah. Yeah.
So in Miami, you have to live, what, 45 minutes away many times to be able to afford a place to live when you work in Miami. It becomes an economic issue for Miami that actually hurts it in the long run. They can't sustain that type of growth, right? The sustainable type of growth is when you have employers come in, median incomes rise, as well as populations rise. And imagine if you had a downtown that is largely just a canvas that is not built up yet, where you have 6,500 people living there versus a lot more than that in many other cities. That's the opportunity that we have in Jacksonville to do this the right way. The foundational things that are really going to drive growth in Jacksonville are there. And it's like, we're building it and the people are coming and a lot more people are going to come, which we can then have this sustainable growth for Jacksonville. So that can be a leader decades in the future, not just a flash in the pan.
It's honestly, man, it's honestly one of the things that I'm most excited about. Like the idea that we are living through this growth period in Jacksonville. Right. Like I'm pumped about the wealth creation that's going to happen for just being in the game in here is exciting to me. And I'm really, really excited about the idea that right now, unlike in Miami, where it was too late for me to get into the game, I've been able to capitalize on what you're talking about, workforce housing. Like the thing that happens during rapid growth and you know, this idea of median incomes rising is the absolute necessity for workforce housing. And I would say that Jacksonville is lucky to have this unique scenario of 4 dudes that decided to grow this amazing team and company that are seeing this with a very long-term vision of having secured access to workforce housing around the urban core, and happen to have young kids that you're trying to like work on a timeline of like, we got to make downtown cool so that people live there. Right. So the uniqueness of this opportunity to me is something that I don't shut up about, whether I'm on the show or not. And I find myself as like the Johnny Appleseed of how awesome Jacksonville is and why everybody that's like under 40 needs to move here, because this is the time, right?
I really believe this is a once in a lifetime opportunity here in Jacksonville.
Yeah, it's cool.
I mean, that's why we are doing so much here. There is an urgency for us to do this. This is why we bought 19 city blocks in the last 2 years in downtown Jacksonville. Like, that's not easy to do. If you could do that over 3 or 5 years, would you probably do that? Yeah, sure. But this is the moment. Other people may not see it. We see it. You know, and it's going to look very different in 3 years, which is just something I love. I love being able to see into the future a little bit, know what's going to happen, come strong and tell you guys that it's going to be a much different equation down the line. And it'll be cool for all of you who are joining the tour here. So we are doing the downtown Jacksonville walking tour on June 24th. If you haven't reached out to Jen Filson and let her know that you want to be a part of that, this is your special invitation to do that. Jen, if you wouldn't mind putting your name and your email address and your phone number in the chat and letting everybody know that is an open invitation. But we're starting to get a ton of people that are going to be on this tour. We were just starting to make plans and backup plans for 50, maybe 75 people. We don't know how many folks are going to be confirmed coming, but it's gonna be a party. I like it.
Yeah, our last conversation of planning this went from like, wow, this is really cool to like, oh my God, we're 3 weeks out. It's gonna be like 60 people.
I know.
So it's gonna be fun. It's gonna be fun. Come see it. I'm really pumped to be a part of it. I'm actually, something that we've talked about a lot is this ULI report that's calling Jacksonville a supernova city, poised to be a supernova city. I just looked it up. I posted it in the chat. If anybody wants to see it, check that out. Give us some feedback on this, like emerging real estate trends from the ULI thing, because I find it fascinating, right? Like I just, if you told me that I could have invested in Boulder, Colorado 15 years ago, I would have been all in.
Right.
You know, like knowing what's going to happen. If you would have told me that I could have invested in Austin 15 years ago, I would have been all in, right? Like all these different markers. So,
or a closer example is downtown Tampa. Downtown Tampa in the last 6 years, 7 years is completely different. It is so strikingly similar to what we have here in Jacksonville, except the canvas that we have and the momentum that we have here in Jacksonville is actually better than what we had in downtown Tampa. just yesterday, my business partners and I went to Tampa, and
Really?
we went and toured downtown Tampa with the creator of this. It was a $6 billion investment in downtown Tampa. It was master plan. It's placemaking, hotels, multifamilies, condos, working with Amalie Arena and the city and transportation. And I got to tell you, man, it was amazing. And this is the type of individual that we get to work with when we are thinking about what we're doing for downtown Jacksonville. So the cool thing is that this has already been done before. Yeah. It's been done literally in our neighbor, like next door in Tampa.
Yeah.
And the
similar conditions, waterfront property surrounding the downtown.
It's so strikingly similar. I was sitting there at a rooftop bar. We were having a drink in the afternoon, and I'm looking at the river, and I'm like, oh, I feel like I'm in Riverside right now, looking at downtown Jacksonville. And it was just so strikingly similar. So it's really fun to think about that. This is not new. This isn't something that we're creating out of nowhere that has no model for following. It makes it that much more real. It's just exciting. It really is. And you should see what has happened to the property values all around downtown Tampa.
Yeah.
That's why we all should be very, very excited. For all of you, for the 2,500 properties that you all have bought with JWB that are in the neighborhoods right around downtown, like that's how we help you make the best return on your investment. It's not just from the appreciation that you're going to get from being in Jacksonville. Like, this is a special opportunity for growth to happen in downtown, which does affect all those other neighborhoods. And that's the real opportunity for us as clients.
We're going to get to the property in a second, but I want to bring up another thing that I don't think we've talked about. And it's these cities that we're talking about that have come online and downtown has flourished and all this stuff. I think that up until now, you mentioned placemaking experts, right? Like, placemaking experts were this like very niche thing, right? We had Stephen Wernick on the show not too long ago. He's a placemaking guy, right? I feel like this is the city that it's happening to next, post free information everywhere, right? Like these cities downtown started blowing up. Like the ability to get into these cities started happening before the internet had gotten as like free flowing to where like 17-year-olds are experts on real estate thanks to TikTok.
Right.
You know what I mean? Like we're at another level of information sharing that has happened rapidly in the last 3 to 5 years.
Yeah.
Right. Prior to that, YouTube was not Encyclopedia Britannica. Now it is.
Right. Yeah.
Right.
Yeah.
So like I think what's really exciting is the predictability of how successful it's going to be based on you can now amass all the best practices of all the places and compare all the data and blah, 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 and do it correctly. And B, the demand, once people start figuring out, is going to go through the roof of like getting in on this once people get it. Yeah. So I think that adds to this idea of like the flywheel hockey stick thing going up through the roof, which I hadn't really conceptualized yet.
That's great. The access to the information, the ability to share it with other models that have worked. Like, this is a really cool thing to do, right? It has such a wonderful economic impact on the city, on communities, on regions, right? And now we have the ability to share this information more widely between other cities. This is what, our team and Alex, my business partner, is the president of our company, a lot of his role is going outside of JWB as a part of the boards that he's on or the leadership groups. One of them is called Leadership Jacks. And that group is a small group of individuals, of business leaders here in Jacksonville, and they travel to Tampa, they travel to Charlotte, they travel to Denver, they travel to Cincinnati, to all of these other cities. And the purpose is to share this type of information and have access to leaders who have done this. Yep. You want to know something really cool? ULI is hosting a conference here in Jacksonville.
When?
This week. Yeah, I think Alex is at it today, actually.
Why aren't we broadcasting live from there?
I know. But how cool is that they come to Jacksonville to host the conference? It's not always Jacksonville going out to other places to go and see what else have people done very well. Now people are coming to Jacksonville and saying, what are you guys doing so well? I see good things happening. So that's a really fun thing.
That's exciting, man. That's exciting. So that to me highlights the idea that your ability to underpromise and overdeliver right now is so real, right? Like
I think so.
As we're about to jump into this property, we are headed into the most important moments of this show, I think, right? Like, I think the economic prosperity that we can make clear to people on this show is a platform for change unlike anything that I've ever been a part of. I think you guys have built this company and you've already done it so much, but the ability for this thing to really spread out and if we can nail the messaging right to like paint the opportunity for the folks that are paying attention and get the word out of like what's happening here, I think it's really like the amount of impact that JWB as a team can make in people's lives is really accelerating, which I think is really cool, man. I'm happy to be here for it.
Well, it's amazing. And we would love help from all of you too. Pablo and I were kicking some ideas around about messaging before the show. And we're, you know, where we left was like, this is something that we really feel makes so much sense on so many levels, even more today than it did a year ago or 2 years ago, comparing your options of where you can invest. But sometimes it doesn't feel like it just lands well, like it moves people like it should. Yeah. So we would love to understand, you know, what are some things that really resonate with you as maybe why to invest? What are some questions or reasons still that you say, well, geez, maybe this doesn't make sense. Maybe it's better to put my money in the stock market. You know, this is a great
or a syndication or now
right?
Bonds. You're going to start considering bonds more, obviously.
Right.
Right. So I think that'd be really interesting. And I'd love to hear, like, we hear a lot from like our super fan community and we love them. They're our best friends.
Right.
I would love to hear from you if you're thinking, no, this isn't from me. Right. Like I would love to understand that. And I don't even work for JW, right? Like I'm not going to sell you anything. I would love to just understand what's going on there. Cause I do a lot of poking around with this. We talk about my dad a lot. Yeah. We talk about my buddy, Chris Kraft a lot.
Yeah.
Of the folks that don't get it. I'm just fascinated by what the brain mechanism is. Cause once the light turned on for me, I've gone all in, right? Like I cashed out my RA and I'm doing this and I'm trying to accelerate it as much as possible. Is I just really believe this now. Like I'm trying to get people to move here and I'm trying to get people to buy properties because I think that in 20 years they're going to be like, bro, Pablo, you changed my life. Right?
Yeah, man.
So I think it's cool, man. I think it's cool. All right, let's go to the city. And I'm sorry, we are now going to magically get whisked away to the property du jour. That means the property of the day, Greg.
Love it.
Property of the week. 5625 Alta Street, Jacksonville, Florida, 32208. It's a purchase price of $185,000, 4-bedroom, 2-bathroom, estimated rent at lease of 2 to 3 years of $1,214, and a estimated conventional financing total ROI calculated via IRR of 12.08%. Beautiful looking home. If you're tuning in live, go to jwbinventory.com to download this sheet. But right now, GC, what do you love about this property?
I thought you'd never ask. Here's what I love about this property. Let's talk about something that you don't see too often here. And that's a purchase price of under $200,000, right? If you can buy a property with a purchase price of under $200,000, your down payment is a lot lower than what it normally is. And it's just not that often that you get that opportunity now. So that's a nice thing to point out. Now, I never say that you should make your investment decisions solely because of the purchase price, because what you really should be focusing on is your return on investment. But we know that sometimes capital is an issue for a client, or maybe you're a client and you want to get to 3 properties, but in order to do that, you have to have a property that is under $200,000. This is a great opportunity to do that. Part of the reason why it's not so common to have properties that are under $200,000 is because the majority of our inventory is new construction homes, right? Because there's not a lot of existing inventory on the market. So this one is a renovation. You have a lower purchase price than you would for a new construction home. And so that's something that I want to point out as a unique opportunity here. Some other things that I think are even more impactful though. This home is already rented. It is positively cash flowing from day one. That's really, really important. In today's environment, it is really hard to be able to acquire existing inventory, to acquire any inventory right now. Most people who are buying a property are going on a waiting list. And if it needs to be built, are waiting 6 months, maybe 9 months, and your money's just sitting there rotting, not earning for you. Well, now you can actually acquire this property. It's available and it comes with a resident who's already paying rent day one. That's just not normal at all. Third thing that I love. Actually, there's a couple more things. Well, number 3 thing that I love, but not the final thing. This comes with a buyer credit. Pablo, when I called you the other day and I was like, hey, I think you should buy this property, this one on Katina. The reason why I told you that I like this one, even though we look at these properties every single day, it's because as soon as it came up available on our list, I was like, that has a buyer credit. Yeah. Let me tell my boy about this buyer credit.
Yeah, it's true.
And just so you all know that you're all my boys and my girls too, that was the one that we literally had that conversation right before we went on live and put it on the property of the week.
It's true. It's true. I don't get that preferential of a treat.
Well, I mean, when you have an opportunity for a buyer credit, you have an opportunity to jumpstart your return on investment in a really positive manner. A buyer credit happens if we acquire a property that is already rented, but it's under rented. So there's a resident in there, they're happy, they meet our requirements, our standards, all that good stuff. They just already have a lease where they're paying less rent than the market rent is right now from whoever was renting that home out before. That's just the way it was. Well, what we do at JWB is we supplement what that rent is versus what the market rent is today to make sure this is an asset that we can sell to you and that will deliver the return on investment that you need. So what all of that mumbo jumbo really means is you buy this property, you get a check at closing. And this check is $3,360. That's what buyer credit means. Like you're buying a property and you're getting paid at the closing table, which is a wonderful way to start off your returns on investment. Anything you want to add there before I go into some of the other reasons?
I was just going to say it to me, the buyer credit, the way that you explained it to me, it's like playing with house money.
Yeah, man.
Because it is house money. Because you're buying a house.
Gosh, I see what you did there.
But, you know, like to me, house money is like, I sit down at a poker table and I sit down with $100 and I immediately make $100. And I'm just like, oh, okay. So from here on out, you know, like I can play with this $100 and there is more upside that I have,
Yep.
but I'm still, the downside is still the same. There's just more upside. And then like what I expect to do is still good, right? Like this idea that if the resident stays longer than you thought, rent's still going to go up and there isn't going to be a turn.
Yep.
The idea that if there is a turn, it still goes up to that anyways, and that's covered. Like, it's just like a little bit of extra juice. I love the buyer credit.
I mean, all of our properties are the same, in my opinion.
Yeah.
Right. Like these are widgets. But if there is something that has a buyer credit, that's something I'm going to highlight.
Yep.
Because in the long run, your returns are still going to be the same, in my opinion, whether you buy a property with a buyer credit or without a buyer credit. You hold on to this thing for 10 years, 20 years. I'm sure your returns are going to be the same. But it is really nice to start off with some house money. It's just emotionally nice to be able to give you a check right up front. Now, over time, you're not going to have that same rent that's on the eval, right? You're going to earn slightly less each month than on the eval, but you're giving some of that back with house money over time. And then you still have upside because when that resident renews, they renew at the market rate.
Yep.
And so you could seriously find yourself in a place where you have that upside, you earn more. We under promise and over deliver on the eval. And so that's why I like to highlight buyer credits, especially for properties of the week.
And we just talked about it Tuesday. $3,000 today is worth more than $3,000 in a year.
Gosh, I love that.
Yep.
Time value of money, baby.
Let's go.
We ain't afraid of that. We ain't afraid to talk about concepts like time value money, IRR. We're IRR ninjas now, aren't we? Yeah. Home is available now, which is availability is one of the most important parts of investing right now. It's just such a lack of supply and lack of inventory out there. And that's important because when you buy a house, when you put it under contract today, you can lock in your interest rate today. Pablo, what's going to be happening with interest rates the rest of the year?
They are going up.
Way up.
Way up.
Way up. Another 5, maybe 6 additional rate increases by the Fed. These aren't going to be your typical quarter point increases by the Fed. The Fed's coming out and saying they're doing twice the size of the interest rate rise. They're usually doing a half point. Or excuse me, they're going to be doing a half point. They just did a half point for the last one. All of this has a long-term, it has an indirect effect on long-term interest rates. So the interest rates you can lock in today are going to be less than what they are when you make that same decision 6 months from now. That affects your cash flows. That affects your overall return on investment. So I'm speaking to you. If you're thinking about buying a property in the next year, you should be buying it now. You should speed up your process of buying that, whether that is taking money out of the stock market, which is probably going to take a beating over the next year, and putting that into rental properties, right? You should be doing that now because home prices are going to be going up in 2022 and interest rates are going to be going up. That's why I love the property.
Lots of love.
Yeah.
That's a lot to love. Hearts. Greg Stone brings up an interesting point in the chat here, and it said that we almost sounded like pirates there for a moment, saying Kia and IRR. So I feel like there is a distinction of like the ninja sound is Kia like that.
Okay.
There's Kia of a cowboy. Maybe we can throw that in there somewhere.
Okay.
And then there's IRR where we are an investment pirate. Just saying.
I love everything category pirates. I love IRRs. And I think it really rolls off the tongue with R. I mean, I'm thinking more like a pirate today than a ninja.
You are.
Yeah. I mean, this is really important.
I'm glad we went there. GC, as you're talking about all of this, one of these speaking points and things that we're trying to land on, folks, which I think is important to me as I'm making this decision, right? Like I am right now in the process of closing on this house and freaked out that I don't get my mortgage before it goes up, right? Like the lever of the fact that like mortgage rates are going up and prices going up and all this stuff, right? And what that looks like in immediacy. I've stopped thinking so much of this house as a house, and I'm thinking about it much more from like the pile of cash, right? Like if I have $50,000, right? Like I very clearly looked at my old IRA that I had $100,000 in to start the year, and then a month ago it was $80,000.
Right. Yeah.
Right. And I'm just like, what can I do with 80 G's? When I cash this out, it's going to be about 58 grand. What can I, is it in my best interest to have $80,000 in the stock market right now? Or is it in my best interest to have $57,000 in a rental income property that either way, it's money that I wasn't going to tap into for 20, 30 years anyways, right? So like the idea that once as the levers of interest rates start going up and the cash flow on a monthly level start going down a little bit, but this IRR number is still going to be more attractive to me than the other investment out there, right? Like the timeline of it starts to land much more, right? So when I look at this house and I look at this like timeline of like $3,000 in my pocket right now,
right,
right, and mortgage rates about to go up, I'm just like, damn, I wish I had another IRA I could cash out right now.
I do too.
Yeah.
Don't we all?
Yeah, cool, man. So Leo Faraganan
Dun, 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 dun.
is asking, is this property still available?
Yes, this property is still available. I did my research. In addition to all the other research that we do for the show, I did that one really important piece of research right before we jumped on, and I checked to make sure it was still available. This one's still available.
Cool.
So if you are interested, reach out to your portfolio manager. If you're not a client of JWB yet, you can go to chatwithjwb.com and get on the phone with us. And whether this one is still available by the time we have our conversations or not, there are going to be other homes that are very, very similar to this one. So we love this one, but this isn't the only one that we love.
Cool. All right. So let's talk about IRR. So we went hard at IRR on Tuesday.
Right.
Trying to teach the concept. I would love to hear some feedback. I know that it was complicated as we were explaining it theoretically, and we got the feedback in the chat. So we dove into the numbers. I would love to hear any kind of feedback right now in the chat. If you're feeling a little bit more confident as a pirate or a little bit less confident as a ninja. So we'd love to hear that. But for right now, GC, explain to me the IRR calculation here of 12.08%. Talk me through it.
Real simple. I mean, this is how hard your money is working for you each and every year. As I loved how you talked about your decision as an investor. It's like, I've got a pile of money. What's the best way that I can accomplish financial goals with that pile of money? Mm-hmm. I think if you think about houses that you're buying, it's just an asset. It's just, you've got this pile of money and it happens to be a house. It could just as easily be a bond. It could just as easily be a share of stock. It could just as easily be, shares in a syndication, right? That helps us be more objective about this. One of the biggest challenges with investing in rental properties is people tend to be too emotional because they think of themselves living in the house. I love your idea. I love your mentality, right? How can I use this pile of money to accomplish my financial goals? And you're like, well, I could put this pile of money in the stock market, right? Short run in the stock market doesn't look good. We did this show for our client only call and for our Jacksonville real estate market update probably 3 weeks ago or so. And we looked at how we have been in the longest and strongest bull run in the stock market in the history of the stock market. Our bull run in the stock market has lasted 50% longer than the next longest bull run. And that bull run, the second largest bull run, was 50% longer than the third largest bull run. So like 13 and a half years, the market's been going up, stock market. If you believe that everything is cyclical, if you believe that what must go up eventually will come down, you would look at this data and say, we are probably in for some pain in the stock market, right? So if you're going back to this pile of money and you're like, well, what do I do with this pile of money? Short run, you're like, stock market, I'm just trying to get out of there, with keeping my capital rather than growing it.
Yeah. And
then you're looking at, all right, what can real estate do for me? Yeah. Well, this 12% return on investment that we're talking about here, that is that great equalizer. You could either put your money in the stock market, and the average bear market loses 36% in the stock market. It lasts 9.6 months, and on average, it loses 36%. That may be, and probably will be where we are headed in the stock market. Yeah. So short run, you're like, listen, I can lose 20, 30, maybe 36, 40% in the stock market in the short run. Or here, I can buy an asset that is producing 12% each and every year, and it has 5 ways it can pay me. I think I'm going to probably cash out my IRA, and I'm going to go do that, right? Another thing to consider too is that the vast majority of Americans only have their wealth in the stock market, stocks, bonds, mutual funds. Like, listen, if all of you only had your money in real estate, I'd be like, yo, I love real estate, but like, there's probably a play for diversification. Yeah. Right. That's really the way it is in the stock market. So even if you have an asset in the stock market and you have an asset in real estate, and let's just say it produced the same in the short run and the long run, which isn't the case. Real estate wins in the long run. When you use smart debt. But even if it was just the same, you can make a case and say, listen, you should probably just diversify. You shouldn't have 100% in the stock market. You should have, maybe 33% in stocks, 33% in bonds, 33% in real estate. There's that angle as well. So I don't know. I don't really know where I started there, but I just started to rant.
I don't know if you answered my question, but it was very passionate.
I don't know.
It's very passionate. You know what I like where you went there, man, is that as you're explaining this to me, this asset class, this idea of right now and the timing of it,
right?
It applies for piles of cash.
Yeah.
Right. Like if what I'm doing is just taking 10% of my paycheck and every day I'm putting it into the stock market, then yeah, man, I'm like time average value, whatever they call it. What is that, time value averaging or what's it called? I know
dollar cost averaging.
Averaging.
There you go.
Yeah. I'm like dollar cost averaging in, I'm building up a stack, right? Like this investment class for folks that already have built something up. It is somewhere, hopefully making some money for you. Most likely has lost some money over the last quarter.
Talking about the stock market.
The stock market. Yeah. And it's available to you, and or you got a big bonus check.
Right.
Or even, man, I just, to me, the idea of what happened to me with that Peloton stock, just like locking in the gains, right? Like even if in the last quarter you've lost some money in the stock market, think about the last 13 years of prosperity that you've gotten.
You're way up.
And if you're way up, right? Like you're way up. And if you can take 25% of that way up machine, lock it in, because now it's house money.
Yep.
You can make some house money.
Exactly.
Right. Like that to me is like the language and the things that we're trying to like talk about to see if it lands. Because to me, it was very obvious enough to do this thing. Yeah. So we're trying to figure out,
I think there's this momentum to get out of the stock market as well, right? If you think about why people have been latching onto crypto,
yeah,
right? Like people are looking for a way to diversify in other asset classes. Crypto was the latest thing on the block, and there was a lot of just frothiness and a lot of money being thrown around in our economy. And people are like, well, I want to get out of the stock market. They're probably thinking, well, I can't get into real estate. I can't get into rental properties because I think it's too hard, which you guys know JWB has solved that problem. But for other people, they're like, crypto's easy and it's not the stock market. I'm going to go put a bunch of money in there. Yeah. And that is part of the reason why it rose the way it did. that is also a part of the reason why it has crashed the way it has crashed.
Yeah.
People wonder about the utility
Yeah.
of Bitcoin and of crypto. That largely is that equation hasn't been solved for most people. Real estate is that option that is not the stock market, that has fundamentals that clearly beat the stock market here. When you look at 12% returns, that's better than you can earn in the stock market over the long haul. And there's utility here. Like it makes sense.
Yeah.
I understand it, which is saying something, because when we get to crypto and some other places and other things in general, I struggle. But this is one thing I can understand is the house provides shelter.
Yeah.
People are going to pay for it.
Workforce housing.
And it's workforce housing, which even makes
Workforce
more
housing.
sense.
Yeah, correct. Like that to me, when we started talking about workforce housing, I was like, man, that's a whole nother level of value, because most cities around the country that are doing economically well, the biggest pain point is a lack of workforce housing. And that means less demand, less supply for an increased demand, which is good for the economics of the asset class.
Yep. You look at some of the other darling cities that have just blown up as far as median incomes going up, that didn't have a solution for the missing middle housing, which is also, it's another way of saying workforce housing, right? Seattle, San Francisco, right?
Yeah.
Major problems
Miami
there.
also.
Miami as well, right?
I always bring that up, right? Because I lived it. Okay, so I feel like you and me are going bananas out here, because we're just, we've been having this conversation, but we got a great question here from Gerard Wendling. Gerard, welcome to the show, my friend. Good to have you back. He says, hey dudes, what are the numbers for non-recourse, and how does the IRR compare to the ROI?
Wonderful question, Gerard. So we haven't talked about non-recourse in a long time, not because we still don't love non-recourse, but non-recourse is something that is used on a smaller scale. A smaller percentage of our clients use non-recourse financing. And, when we were revamping our evaluations, I'm like, you know what? Less numbers is always better, right? So, but we still do have non-recourse options. And for anybody who's just unfamiliar with what non-recourse means, that's a type of loan, largely a loan given to you when you buy a property in your retirement account. So the terms are still very advantageous in terms of non-recourse terms compared to what they were in the past. Non-recourse will always have worse terms than your typical conventional Fannie and Freddie products. So with that being said, your rates right now, I think, are 6 3/4 for your non-recourse loan. I think you're putting down 50%. What I would recommend is reaching out to my team, Gerard, to get the actuals on the non-recourse lending products, but absolutely available. When you're talking about IRRs, your returns on investment are going to be in between cash and in between conventionally financed properties. Okay, so if your conventionally financed returns on investment are 12% and your cash is, call it 9% here, if you buy the property in all cash, your non-recourse will be somewhere in between. And that is because largely you're using 50% leverage instead of 70% leverage, which is what you use for conventionally financed properties. If you're interested in what those numbers actually are, reach out to my team. If you have money in your retirement accounts and you're resonating with this message of like, how do I get it out of the stock market and put it into an asset that is more consistent, probably going to do better in the short run and definitely does better in the long run, reach out to my team. We can have those conversations. That's a very similar equation to what you just did. The only difference is you use non-recourse financing if you want to keep the money in your retirement account, keep it in your 401k or keep it in your solo 401k or in your IRA. The decision Pablo made was to take it out of his IRA, pay the penalty, pay the taxes to get it outside of that. So then he could take advantage of the conventional financing option, which either may be the right decision. Need to have a conversation with you before you make that move on that. So reach out to our team and, be happy to have that conversation. And thanks for the question.
Cool. By the way, shout out to David Singy, because Leo asked, where's the link for this property? Normally Madison the Magnificent is here to share that. I didn't get to it in time, and David posted it in the chat.
All right.
Helping out Leo. This is why our community is so awesome. Thank you, David. I really appreciate that, man.
Awesome.
All right, cool. So the other question that Gerard had is, what is the difference between ROI and IRR?
All right. So return on investment is critical to your understanding of how to make this investment. return on investment, ROI, is a wonderful tool. It's very simple, and it works largely when you're using an investment that has like a 1-year horizon. Because when you're calculating your return on your investment, it doesn't imply how long it took you to get that return on investment, right? If you bought a property and it was worth $100,000, and then it turned into a $200,000 property, and it took a year, well, that's awesome. Let's say you used cash. So your return on investment would be that 200,000 minus the 100,000, which equals 100,000. And you put $100,000 into it, that's 100% return on investment. We're all stoked if that would happen in a year. But if it took 30 years for that to happen, would you be as stoked? The answer is no, right? That'd be like a 2%, 2.5% return on investment each and every year. That doesn't get us fired up, right? So return on investment is great if you're talking about really kind of like a 1-year horizon. It's return on investment and IRR are going to be the same in a 1-year environment. When you go longer than 1 year, ROI does not serve the purpose. It actually gives less information. It uninforms you as much as it informs you. It's just less valuable. And so as we start to analyze this asset class and we count on things like home price appreciation, and we count on things like principal pay down, those are things that happen each and every year, but they don't hit your bank account until you sell or you refinance. And the easiest way to show this is over a 10-year schedule. Call it a 10-year IRR schedule. Well, you can't use ROI to evaluate things that happen over a long period of time. That's where it breaks. In this asset class, you win by holding on for a long period of time, right? IRR allows you to take into account how much time it took for you to get those returns on investment, and also allows you to take into account the variability of those cash flows. You might have 1 year where you don't have any maintenance and vacancy costs. Your home's rented, so you don't have a tenant placement fee, and we just got another $100 a month in rent for you. Well, that's going to be a great year for cash flow for you. It's going to be really high. You may have another year, 3 years down the road, where you have a property turn and you might go negative $3,000, right? So IRR allows you to equate for all of these things, this timing, as well as the variability of cash flows. And it gives you one simple, easy to understand number that you can use to now evaluate this decision with a pile of cash versus another decision with a pile of cash that you could put in bonds or stocks or crypto or syndications. So long way of saying IRR is the approach when you're analyzing investment decisions over the long haul that have variation in cash flows that come in over the years. And ROI just simply doesn't work for this investment unless you're flipping it. Unless you're buying it today and selling it next year, ROI can work for you, but it's not what we believe here. That's not the intention of this asset class, at least the way that JWB does it.
I got a question here from David Singhi, who is asking, how's JWB's inventory for new builds and rehabs for the rest of 2022?
Oh, geez. Well, that's a longer term outlook. What I was going to share with you is right now we've had a lot of homes that have just come and been released, new construction homes.
Cool.
Yeah. Like right now we don't have a waiting list,
okay,
which is wonderful.
That's great.
Waiting lists are going to be here or they're not going to be here. It's going to be an ongoing discussion because it's largely determined by how many homes our new construction team releases, and then also how many properties you guys buy. So if you go on a buying spree and we don't release any homes that week, well, guess what? There's a waiting list. So easy for me to talk about inventory today and this week, harder for me to plan it out 6 months down the line. I think the inventory conversation will be a part of what we talk about often, and I'll just keep you updated. But for right now, this one is available and there are other homes that are available right now. So availability, as we talk about how important that is, this is a great time to have homes available, a great time for you all to pick up your assets. Again, as comparing this to what pain is about to come into the stock market, as many experts believe, like this is the time to move that money. You have inventory available at JWB. I hope you take advantage of it.
There you go. All right, we got a question here from Eddie Harris from Atlanta. And he's asking, I'm going to put the property back on here. He's asking, hey guys, if you had to put ROI in this property as opposed to IRR, I am assuming the ROI would be higher, but not accurate for yearly analysis. Thanks.
Yeah. And Eddie, it's great to hear from you. Great question. Eddie, I'm not sure if you were on the call on Tuesday, but we actually went through this exercise. And so if anybody would like to see comparing apples to apples, what it would look like for a standard ROI calculation versus an IRR calculation, you can go back to the show on Tuesday and you'll be able to see that. I'll give you the spoiler version of it. It's much higher for ROI. So the fact that JWB produces an IRR is very different than what you are going to see from other turnkey providers, partly because it's complex and partly because it drops the expected return on investment. But that's real. For somebody to put an ROI in front of you and tell you that it's a rental property that you're going to own for multiple years, that's just not accurate. Like that should be a sign for you all. If you're thinking about buying rental properties from somebody else and they're including home price appreciation and they're talking ROIs, they don't understand or don't talk IRRs. They are artificially inflating the returns on investment. And that should be a sign that you probably don't want them managing your money because they're never going to hit them 10 years down the line, right? So the example, which was actually your property on Katina.
We got it in front of him now, GC. Explain it.
Love it. All right. So on the left here, we've got Pablo's property here on Katina. And you see that 20, you want to zoom in there on that 20.7% there, or at least highlight that one for me. Yeah, there we go. 20.07%, right? That's saying that that is what your ROI calculation would be for the same property. Whereas if you calculate it, taking into account how much time it takes for you to receive the money and also the variability of the cash flows all along the way, that is the same property as an 11.93% IRR. We even went one step farther and we said, you know what tricks other rental property providers use to juice their returns? They don't include tenant placement fees. They don't include maintenance and vacancy costs. They don't include closing costs. They go really aggressive on the rental rate that they can possibly get. You know, many times they'll put a property in front of you that'll show 20 or 25% ROI for a buy and hold property. That is just not realistic. That is incongruent with how real estate markets have worked over the past 40 years. And so the chances of them being able to show up 10 years down the line, 20 years down the line and say, listen, hey, I told you we were going to produce a 20 or 25% return for you. Guess what? Here's what we did. They're going to come in way lower. And that's the real risk. We know that. We know how to calculate returns. We care about showing up and delivering. So the IRR is the only way to do this.
Yep.
So,
and real quick, I went into the analysis by conventional financing tab so that it illustrates it, right? This ROI number that you see down here, it's again conceptual, right? Whereas this IRR number shows year over year. You go through it and it shows what your actual return is each year, right? It just keeps going up yearly, and then in year 10 you cash out. And what you see in this is that down payment, acquisition costs, and net rental income, cash flow, and tax savings are all included in year one. Then as you are just holding the asset, it's all about the cash flow and the tax savings that start happening. Cash flow goes up over time, tax savings stays constant. And then this is the analysis of actually cashing it out. That includes your closing costs. It includes what you made on appreciation. It includes what you profited from debt pay down. So it's a real number.
Yep. Go over to the left and go over to the left there. Okay. The two biggest things that should jump out to you that you do not see on an IRR, that you do see on a 1-year return on investment, is home price appreciation and principal pay down. If you wouldn't mind highlighting those for me, there you go. So in an ROI, the reason why they can claim and it inflates your return on investment is because they say after you buy and hold this one property, you're going to put $10,000 in your bank account for home price appreciation. That just doesn't happen. That's not how this model is built. So for other providers to say, hey, listen, we're going to produce this return on investment, what they're in essence saying is that we're going to teach you to sell. We're going to help you sell this property in 1 year and sell it with appreciation baked in. And on top of that, they're not going to account for any selling, holding, or closing costs. I haven't figured out how to sell a property without any selling, holding, or closing costs.
True story.
So it's like grossly inflated to include home price appreciation in an ROI calculation. Same thing with principal pay down. It's there, but it doesn't hit your bank account, which is why you can't put that in to an ROI. That's why in an IRR, you don't see it there in the first year, right?
Mhm.
It didn't hit my bank account. It paid my principal down, but it didn't hit my bank account. My home price appreciation happened. It just didn't hit my bank account. Here, it doesn't happen until year 10. You're doing really well, Van. I appreciate you. Well, that 10 years that it took me to earn that, that's important to know. IRR calculates what your return on investment is, taking into account that it took you 10 years to get that. Because if you just put it in year one, that is artificially inflating it unless you're going to flip it in a year.
There you go. We got one last question before we get out of here. David Singh, who has been the MVP of this episode. Just throwing it out there. Just throwing it out there. MVP of the episode. Lee, you're still the MVP of the community. He's got a long way to catch up to you there. But today's game, David Singh gets the game ball.
All right.
All right. What are the price ranges for the new builds right now at JWB? Trying to plan on how much I'll need to hit that 30% down payment and closing costs.
You know, David, I would recommend giving us a call, or, you know, I'm not sure if you're a current client right now, but talking to our team. That may be the right strategy for you. It may not be. We might be able to help you accomplish your goals better, right? Whether we explore renovated homes, new construction homes, whether we explore 30% down, maybe 25% down, maybe 20% down. For some clients, we still advocate 20% down. So these are conversations that we can definitely help you with. As far as purchase prices on your new constructions, typically about 225, maybe to 280 or so. Your renovations are largely kind of that 180, somewhere around 200 price range. So I would really recommend, if it's about saving up the capital, I would really recommend talking to my team about renovated homes, right? So many people look at this investment with their eyes and they say, geez, it just has to be new construction. That's not the case. I own more renovated homes in my own portfolio than I do new construction homes, right? We got to get over how this looks. We got to get over the fact that new construction is just new, because at the end of the day, when you hold on to this thing for 10 or 20 years, it's not going to be new construction anymore. So I would really, really advise you to do that. I think this home for you, David, might be a great option. Imagine you could put 20% down on this home. And I'm not saying that's the right amount, but I'm just trying to show what the possibilities are. You know, 20% down for, 185, what's that? Like 37, 38 grand plus closing costs,
4313. $43,013.
There we go. David, I don't know what capital we're working with, but there is such an advantage to buying now versus buying later, because home prices and interest rates are going up. I think that might be an opportunity for you. Yeah.
So there you go, David. I mean, if we're going to ballpark it on this one, right? Like, I guess you want to fudge between that 20% to 30%, depending on what your goals are, right? If you're looking for cash flow, you're looking long-term to have the asset appreciate and pay you back 30 years later, right? Like we always talk about this idea that this cash flow, I'm going to put the property back on real quick, that this cash flow that is shown on summary right now. So I've gone as far as putting it down to 20% to make that 4303 in this analysis conventional financing tab. That means that your IRR actually goes up, right? So you get higher return. And at the end of the day, one of the things that landed on me is that this is the number that you're playing for in longevity, right? Like if you're going to hold it for 30 years, then at the end of the day, you're at least going to be getting this like $819 per month in cash flow later in your life, right? Like GC and I talk a lot about this idea of how this affects you on your day-to-day life. What is the feeling? So depending on your time window, then it is, one of those things of like, are you looking to see what you get out in 10 years? Or are you looking to see it as like, hey man, in 25 years, what kind of cash flow will I have coming from this thing that I can then like let my kids leverage, or you're going to be able to cash out and refinance stuff and things of that sort. So it's a really, really interesting conversation. And yeah, that's $819 in cash flow per month, assuming that the rents don't rise.
Yeah, right. Rents are going to rise. Expenses are going to rise as well, property taxes. But that's the beautiful thing. This is why this is a hedge against inflation. Your rents rise, your expenses rise. I mean, we're really talking about producing an asset that's going to kick off, call it $1,000 a month net.
Yeah.
Without a loan on it in 20 years, 30 years. Imagine if you bought 10 of those now.
Yeah.
And talk about retirement planning. This is what I did in 2006. This is why I got fired up. So when people are like, oh, geez, doesn't have cash flow, they're missing the picture. It's like, what can this do for me in 10 years? What can this do for me in 20 years versus what will my current decisions with my piles of money do for me?
Yeah.
And this is where it blows it out of the water.
Another great question by David. He says, you're right, GC. Thanks. Can you also help me get over the fact that if I bought the house today and held for 10 to 20 year cycle, it's a 100-year-old home? 100-year just sounds like so much to me, but I don't really know what it means in terms of maintenance.
Great question.
Great question.
Yeah, that's great.
Yeah.
Homes, listen, we have a lot of history here at JWB of homes that are older, right? I own homes that were built in 1920, 1930, 1940. Right? I care less about the purchase date of the home, and I care about the construction quality of the home and the way that it has continued to receive maintenance. The bones of the home, whether it was built in 1920, 1940, 1960, right? Those bones are the same, and those continue to be updated on a regular basis, whether that is through a property turn or if there was a major renovation that went on, right? So I don't care about the age of the home it was originally built. I care about how quality that construction is. When we're talking about this asset, I care a lot more about the income that comes in and the ability for it to appreciate over the long haul. And the great thing is that homes that were built in 1920 that are 100 years old right now are appreciating at a really high rate, right? I mean, the overall market here in Jacksonville grew 26% last year. That wasn't brand new construction homes only, right? Those were homes that were built in the 20s and 30s and 40s and 50s. So I think people have the stigma. They say, geez, a home that is 100 years old or 80 years old can't grow at the same rate as other homes. That's just not real. We got to get over that. Data dictates otherwise. So I would care less about the age of the home. I would care, of course, about the team, and the quality of the construction is a big part of that, right? As far as making sure that this is an asset that does not have deferred maintenance. And then I would just, have an honest discussion and look at all 5 profit centers. And if all 5 profit centers equate to a better risk-adjusted return on investment than their other options, those 5 profit centers are going to earn that risk-adjusted return, whether it's a new construction home or a renovation. I'm ambivalent. I really am. That's why I have both in my portfolio. I hope everybody is ambivalent, even though I know a lot of you invest with your eyes still. You still look at the new construction. You just won't listen to me. But
speaking of which, Tuesday's guest, your boy, George, I need to get this right, Grombacher.
Yeah.
Yeah. Behavioral finance,
Love
right?
it.
The idea that a lot of us rationally look at investing and then we see the numbers, and yet emotionally we make a different decision. That is timely. We booked this guy like 3 months ago. What a timely topic.
Oh my.
I can't wait to talk to George. Super interesting guy. David, you get the MVP for today's show. Really, really great questions. This is exactly what we want, right? Like, we want questions from the community of like, how can we look at this differently? Because I've obviously been convinced by Gregg's blue eyes and amazing ability to generate cash flow. But I want to know what else we need to talk about, right? Because we're convinced, and we love to know what the unconvinced is thinking so that we can talk about it, right? Like, let's bring those things up. Let's shine a light on it. So really, really great show today, GC. I had a really, really good time. I appreciate everybody that was on this call, right? We never take it for granted. Thursday, middle of the day, you spend an hour with us, 30 plus people. If you're listening on the podcast or YouTube, go to nyais.com. Join us for one of these shows so that you can get an MVP trophy for the day as well. And GC, I'll give you last words here.
I love it. I just want to say thank you to you all. Being able to be here, kick it with Pablo, kick it with you all, and just talk a little shop and real estate. It's something I really enjoy. It's because of you all continuing to show up and to make this community so strong is why we get the opportunity to do this here. So I'm just very, very thankful that you guys give us an opportunity to do what we love. Appreciate you. I hope you have a great weekend, and we'll catch you on Tuesday.
There you go. Don't be average and get kicked. Kick it like a not your average investor.